Hi everyone. Happy Friday afternoon. I'm actually here in McCormick Ranch and with Mr. Reggie Green of Fairway Mortgage and his team, Team Green, here to discuss with you the important things about being prepared when approaching that trying to get that home of your dreams, that major purchase, and those critical factors that you need to take care of when going to go after that home. Reggie, thank you very much for your time today.
Thanks for coming down to branch. We appreciate it.
Yeah, I appreciate you letting me come back here and talking with you guys again about all of these things. Uh-oh. I wonder if my mic audio is doing okay here. All right. So anyway, I just wanted to start with just going over some of the basics. What is it exactly that the home buyer really needs to concentrate on when it comes to buying that home?
Yeah, so let's just talk about the three main components that a lender is going to look at when you're looking at home financing. So the three main ones that we're going to look at are credit, assets or down payment, and also what we call a debt to income ratio.
Right.
So
the real important one.
Yeah, that's usually the most important one. So just break them down one by one. So the first one's credit. Okay, now we do have programs that go as low as 580. You can do those. A little bit harder to get through, to be honest with you. Usually you're going to want a 620 to 640 minimum credit score in most cases, but we can go lower in some cases. If your credit isn't there, we at Fairway have a program called Credit Tool where we have credit professionals that look at your credit and put together a plan for you to get there. Okay, we also have what we call credit simulators where we can simulate you paying down certain accounts and what it will do to your credit.
Now, is there any cost for those services?
We pay for them, but we do not pass those on to the customer, no.
So basically, if you're thinking of working towards getting that purchase done and you're not too sure about your credit, they'll actually go over all of those steps with you and work towards building you up to the point where you're ready to go at no cost, and hopefully you continue to use them for the loan down the line. That is the goal.
Exactly.
I mean, but that's a service that's available to you, and maybe you're not sure. Maybe you've had some medical history issues in the past. A lot of times it is medical debt, and they can get that stuff sorted, and get you financially straight and on that path.
Yeah, our goal is to put together a plan so you're ready to buy. And a lot of times people just don't think they can, and a lot of times they can, and it's usually not that hard to get them there. So credit's one of the first things we're going to look at. There was one other thing I wanted to go over with the credit, and I'm trying to think of it, but it's
slipped your mind.
Yeah, it's kind of slipped in my head.
I apologize, it got you off track.
Yeah, we might have to come back to that once I think of that.
So you're talking about how you had the two different programs for improving their credit. How getting above 580 is really where you want to be, and then what's the next level for when you get into your real B and A paper credit? As we're talking about available loan products.
Well, almost all loan products have what we call loan level pricing adjustments. Okay? And what that means is based upon where your credit score is, it affects the rate pricing, and it also affects PMI pricing if you're not putting 20% down. So even if your credit score is a 640 or a 660 or a 680, because usually the pricing adjustments are in 20-point intervals, we really try to look at your credit and try to pop you up as many tiers as we can, because our goal is to get you the best possible product that we can, even if it costs us a little money to do so.
So you're trying to save people money, actually.
Correct.
By putting them in a better product and hopefully a better long-term financial wealth building.
Yeah, better rate pricing, better PMI if there's a PMI on the product that they're looking for. The one thing I did want to talk to about credit that we see all the time is a lot of people use credit services online. Credit Karma is the main one. Okay, Credit Karma does not have the same credit score as when we pull it, and almost always Credit Karma has a much higher score than ours. Okay, so if you are seriously thinking about buying a house, I would really recommend having a mortgage professional pull a mortgage credit report, because it is a big difference.
It's a bit more detailed is what he's saying, really.
Yep. And the score modeling is different.
Exactly. And if it's rated and weighed different, then you're going to absolutely have a different result, and you're going to want to know where you stand to know whether or not we've got some work to do, whether or not you're ready to go. all of those factors. There's so much involved in having your finances prepared so that you're ready, and the more prepared you are, the more benefit it's going to have for you when it comes to going after that property. So we kind of went over the issues with credit, and I wanted to kind of reflect on advertising when it comes to the credit. The numbers they see on TV versus reality are two different things a lot of times because of those factors that credit weighs and the debt to income ratio weighs in. That's going to change their points and their rate, right?
Well, debt to income ratio, usually you either qualify or you don't.
Okay.
Credit definitely affects the pricing of the loan and the pricing of the PMI.
Okay, thank you. So yeah, you're going to want to have those things lined up to get those best rates, hands down. Go ahead.
So the next thing is assets or down payment. So there are 0% down payment loans available. VA is a 0% down. You have Home Plus and Home in 5, which are 0% down. You also have a Chenoa product. So there are various down payment assistance in VA, USDA that do not require a down payment. Then you have conventional loans, which typically are going to require a 3 to 5% down payment depending on the loan program we put you in. FHA is 3.5%, and those are kind of the main bread and butter products. You also have jumbo loans, which really vary depending on the investor.
Yes.
And some specialty portfolio products, bank statement products, things like that, that really vary a lot as well. So typically, when you're qualifying for a loan on a primary residence, okay, usually the assets that we're going to look at are basically the assets that you're going to need to come to the table and basically buy the house.
Right.
Okay.
Your down payment.
Some other loans, if you're buying a second home, you're buying a vacation home, or if you have a jumbo loan, they're going to require what we call cash reserves. And what cash reserves are, money that you basically have saved, so if anything were to happen, you were to lose your job, come into serious illness, whatever it may be, you have a certain nest egg available where you could still make your mortgage payment. That's what we call cash reserves.
Typically the cash reserve amount that they're looking for, months?
2 months to 6 months, just
okay.
depending on what product.
It's good to know. I mean, and you're right. An investor is going to be looking at you as an investment, and they're going to be looking at that risk and whether or not how secure that risk is for the investment in you.
One of the things we see, and we have discussions about this all the time, a lot of people are kind of aware about the 20% down and how you don't have to pay PMI.
Right.
You know, not everybody, but some people are. And one of the common misconceptions we see every day when we're talking to people is when you have a certain down payment where someone says, hey, FHA, you need 3.5% down. Conventional, you need 3% down. Okay, when we say 3.5% down or 3% down, that is the minimum down payment required, which means in all likelihood it's going to be higher than that, because if you're paying closing costs to get a particular rate, you also have what we call prepaid items, which are things that have to be paid that are not actual hard costs, like 1 year of insurance, prepaid interest, escrow impounds. Those are added to that down payment.
Absolutely.
So unless you have a lender credit covering everything, which means taking a higher rate, usually that 3.5% down is usually more like 4 to 5% down.
Correct.
So we kind of have to educate people on that, because the 3.5% down or whatever percentage that you're looking at, it's typically higher than that at the end of the day.
Yeah. So I mean, what you see advertised on TV a lot of times isn't going to show all of those other additional costs that are included in basically owning a home. Because you are going to have HOA, you are going to have insurance, and you are going to have taxes. And I don't think any one of us gets out of those. Last I checked.
Yes.
Well, when you pass.
Yeah.
But so as part of that, that's always going to add on top of that original number that you're thinking that you're going to get based upon the rate. So those are all factors, and that's why it's good to sit down with a professional prior to going out, looking at houses, knowing that your finances are all lined up, and knowing exactly where your comfort zone is, because the last thing you ever want to do is go out and fall in love with something and then find out it's out of your comfort zone for affordability. Now we have to deal with the heartbreak and trying to find something that is going to try to live up to exactly what you now unfortunately aren't really able to afford. So it's more important than ever, especially with low inventory, to get your team in place with the lender as pretty much one of those critical first steps. You've got to be on top of your financing. I can't stress that enough.
Now, one thing, just on the down payment, most products do allow a gift. What a gift is basically usually a family member giving you money towards the down payment. And basically what we do is, let's just say your dad is willing to help you with the 3% down for a conventional loan. Rich uncle.
That would work.
Usually we have to show a relationship there. They basically can give you the money, and then they write a letter basically saying that they're giving you the money without expectation of repayment. And we can usually use that for a down payment if you have a family member or someone very close to you. We do have to prove a relationship to help you with that down payment if you don't have it yourself.
Okay. So there are also alternatives out there that may allow you entry into being a homeowner faster if you get some assistance from family that could help you avoid paying rent for years to come. Yeah. I mean, really, we are at a ratio now in the Phoenix metro market. When you look at rental rates, it has certainly become one of those moments where if you can afford to buy, it is going to be in your favor.
Yep.
I mean, it just really is. You're going to be saving money over time as you build equity, and you're not only that, you're going to be paying less than you would for renting the same type of place.
Yeah.
And it's just, wow. Okay, here we go again. We're really back to the point where you need to get on your finances. You need to get yourself organized and get yourself out of the rental trap if you are doing that, because otherwise it's going to keep costing you.
Yep. Agreed.
So debt to income ratio, let's just go over it real fast because there's not really too much to get into on it. It is one of those factors, it just is or isn't.
Yeah. So debt to income ratio is basically a qualification factor in the loan. It's usually kind of one of the more difficult ones, and the ones that are usually a little difficult for a consumer to understand. So what we're looking at is how much money you have coming in and how much money you have going out, and it calculates a ratio, okay?
Right.
So usually if I'm throwing a hypothetical out there, I say, let's just say you make $10,000 per month.
Nice.
And you have $5,000 going out. Okay, now what we mean by going out is we're not looking at food, entertainment expenses. We're basically looking at things that would be on your credit. Student loans, auto loans, credit cards, your new mortgage that you're qualifying for, the taxes and insurance and HOA associated with that. Also is going to be included is child support, alimony, things like that. Okay, so we're not looking at anything outside of that, health insurance, anything like that. So if your $10,000 gross monthly before taxes are taken out, and your total new bills with the new mortgage are $5,000, then your debt to income ratio is 50%. Okay, so depending on the product, if you're doing a FHA or a VA loan, a lot of times you can get your debt to income ratio through at like 55 to 57%, sometimes even a little higher on VA. Conventional loan, you're going to be capped at 50%. Some of the down payment assistance, 50 to 45. So usually you're going to be in that 45 range, sometimes a little higher depending on the product that you're qualifying for.
Yep. So, I think one of the biggest factors of those, especially with young people when it comes to that debt to income ratio and the affordability, is car payments. I find a lot of times that people should go a little bit more conservative with that car payment because it really does cut into the debt to income ratio, especially if you're carrying student loans.
Yep.
I mean, it just compounds.
Yep.
And it really can make the difference between you maybe getting that out of that rental cycle or staying in it, especially because if you have a high car payment, you're really cutting into your ability to save. Because if you just cut back your car payment by $100 a month, that's $100 you could be putting towards a future 3% down payment. Things that really are important to think about as you're thinking long term towards your goals of that major purchase of having a home, of wealth building, because I can't tell you enough how important it is to stop you're paying somebody else's mortgage when you pay rent. I can't help it.
Yep.
It gets me a little fired up because you should be using that towards your future success. Reggie, anything else you'd like to touch on? I know last time go ahead.
One other thing on the debt to income ratio, we're seeing this a lot, especially with kind of new people that are coming into the marketplace, maybe just graduated college, want to buy a house but don't have a big job history and don't really make a ton of money per month right now, but they still want to get into the house for a lot of the reasons that you just said. A lot of times what we use is what we call a non-occupying co-borrower. So let's just say, you're coming out of college, you got a job making $30,000 per year, and the house price that you want, you want a $250,000 house, but you just don't qualify for it with that income.
Correct.
Okay, if you do have parents or family members that are willing to do what's called a non-occupying co-borrower, what they do is they're actually signing on the loan and the title with you, and their income is helping you qualify for that loan. And what a non-occupying co-borrower basically means, it kind of says for itself, you got a borrower that is not occupying in the residence, but they're helping you qualify, and then you have one borrower that is using this as their primary residence. And we use that tool all the time. And eventually the goal is to probably refinance it. Correct. And get it into your name alone. But to help you qualify and get in the house now, it's a good tool.
It certainly can be a jump start on really getting your long-term goals. I mean, it can really jumpstart be a huge help there.
For sure.
I don't need if your parents are willing to do it, I'm sorry they moved out at 18. It wasn't over. You're still gonna have to help them out. And if you help them out this way, chances are you're going to be helping them out way long term, because it's putting them just on a path for much better success. That equity can be used so many different ways down the line. I mean, don't tap the equity if you don't have to, but maybe you have a family later on and you want to go to a larger house. You can now use that as your down payment vehicle to move into a larger house. Or maybe you keep that house as an investment vehicle and you tap some of that equity there's so many ways.
Yep.
So I mean, it really does just open more options for you financially, as towards what we all work for in this country, is just having more financial freedom, right? I mean, definitely. That's the goal. That's kind of the American way. That's checked.
More financial, more personal freedom, right?
Yep, that's it.
Yeah.
So last time we talked about South Scottsdale, and I do kind of want to continue to touch on that. There are a lot of opportunities out there, I think, with properties that may be being overlooked because they've been on the market a little while or a little ugly for this reason or not. And I think there's an opportunity there that you might be able to actually capture a property and then enhance that value to where it's going to easily appraise for your improved value and make a home for you for longer term than you would have expected with maybe just getting a starter home, or maybe something until the family grows a little bit larger. Maybe you can get that little bit bigger.
Yeah.
I really think there's an opportunity that's possibly there, and I know I've seen the activity, so I know people are taking advantage of this. And I just want to continue to bring it up because I think it's important that if you are trying to identify these properties in a limited inventory environment that we're in, to look at all your options.
Yep. So basically what David is kind of referring to is the renovation loans that are available on the market today. What a renovation loan is you're basically financing a remodel work or things that you're changing on the house into effectively the purchase price. You can't move up the purchase price, but you're basically financing into what we're calculating your percentage financing off of. So, you're basically remodeling and putting it into the purchase versus doing it afterwards.
Right. So you're rolling it all into one.
Yep.
And in that way, it kind of streamlines things. You're not actually out having to get a separate loan for the renovations. And I think that's kind of big because a lot of times you don't know what product you're necessarily going to get when you're looking for that construction loan. And when you have it all rolled into one, now you know what your payment's going to be and you're done.
Well, and a lot of people just don't have money for a down payment and the remodels that they want to do afterwards. So what you're doing is you're kind of combining them. So you're just coming up with a down payment and not having to do the remodels afterwards because you're financing it at the beginning.
Correct. And a lot of homes out there don't need a huge amount, but wow,
exactly.
You can get that home that you want and be able to move in and have it be that fit and finish that you're wanting. But not necessarily finding out there for the price that you want. Really?
Yeah, when you look, especially in certain areas like South Scottsdale, you got a little older, you come in there, if you look at it a certain way where, hey, I like this area, okay, but the kitchen's not great, okay, you can change that and make it exactly how you want it. So when you move in, the work's being started, and make it exactly how you want it when you move in.
Let's swap out the kitchen cabinets. Let's maybe update the flooring. Let's swap out the bathroom cabinets, and now we're ready to go. I mean, I think that is something that is really important when you're out there looking, because it's not always going to be that turnkey property.
Yep.
I mean, we all watch HGTV and have seen that, and you walk in and you're like, wow, it's great.
Yep.
Most homes aren't that way. I mean, it just doesn't work that way. So,
yep.
I mean, I think this opens up an option to allow you to really make that house the way you want, right as you move in.
Unless it's a flip, which they're already making money off what they put in, right? So you're paying higher for that.
Yeah. No, we all know that. And
what's up, Brandon?
You know, you never know how that work's been done either.
Yeah, exactly.
And there's that other X factor. So, I mean, but you know, that's why we always say get a home inspection. Always important.
Yep.
So, hey guys, I appreciate everybody coming and tuning in today. I got Brian, Brandon, Scott, Sarah, Terry, Josh, Belinda, another Brian.
Hey.
Wow, this is cool. I really appreciate you guys all taking the Friday afternoon to sit in here and listen to us go over, you know, some of the basics. But I feel it's important that we cover these topics and, you know, kind of repeat ourselves a little bit, because I can't stress enough the importance of having your team and your financial act together, especially when you're out there competing against other people for that same property. You know, Mr. Green here and his team are willing to call and talk to the listing agents when you're trying to go after that property, to explain to them that they're confident in their ability to get your loan financed. And I can't tell you how critical it is nowadays to have every member of your real estate team working towards your goal together, because I have seen much greater success this way, and I feel that, you know, really it's kind of the way things are, especially given the environment of the market.
Yeah, I want to read a text here real quick, because we really stress to the agents that we work with and the clients that we work with, let us help you get the house. Because, you know, if we call a listing agent that you put an offer in and there's 3 other offers, and me as a lender call and say, hey, this person has great credit, super easy loan, I can close this in 2 weeks if you need me to. I'm going to send you an update every Tuesday with an LSU. You're not going to be wondering what's going on because we're constantly updating you. Okay, it's going to make an impression versus the other offers. So this is a text I got today from one of the agents we work with. The selling agent said that the reason our client's offer was most attractive is that they were very impressed that the lender called them after the offer was submitted, even though our offer was lower than the other offer. Thank you so much. You know, so things like that, they do make a difference. So let us get involved.
Right?
Yeah,
It's those little extra things, especially when it comes with communication, and that they're feeling that that's going to be there throughout the transaction, so they're not worried about whether or not, oh my gosh, at the last minute, is that loan going to close? No, they're actually confident, and if you've got your financial act together, he can go and sell you to that listing agent along with your real estate agent, your realtor, who's presenting you in the best light possible along with your offer as the right pick for that home. And I think those things pay off down the line.
Yeah, it's a great first impression, and they just know we're being proactive when you're buying the house. We're going to be proactive during the whole process, and it just makes a good first impression. And all things being equal, they're going to go with that.
Yep. I mean, it makes a difference. It really does. So you really need to, I think if you're thinking about doing this, reach out, give a text, get in touch with us. Let's put your team together so you are comfortable in the decisions that you have to make in procuring your real estate goals. Mr. Reggie Green, I can't thank you enough for your time again. I mean, it is
awesome.
Always,
good to see you, buddy.
Always great to have you let me come in here and pick your brain for everybody else out there. I know I do appreciate all of you watching, and so on behalf of Mr. Green with Fairway Mortgage and the Green team here in McCormick Ranch, great guy. David Pierce here, Realtor, Associate Broker with the Home Team AZ at My Home Group Real Estate and MHG Commercial. I do a lot. But really, guys, I want you to get out there, have a great weekend. Remember, be positive, be productive, and be proactive. The key word, proactive, in all the challenges that you're looking to face and all of those goals that you're looking to accomplish. Have a great weekend.
Take it easy, guys.